Welcome back to the Explainer. Today, we are stepping right into the valuation lab. We're going to put on our equity analyst hats and conduct a rigorous top-to-bottom stock valuation. Our subject? Black Hills Corporation, trading under the ticker BKH. Our ultimate goal here is to cut through all the market noise, strip away the sentiment, and uncover the true intrinsic value of this company using hard data and proven financial modeling. Let's get into it.
All right, first things first, let's anchor ourselves. The current market price of BKH at the last close sits exactly at $75.50 per share. Consider this our baseline hypothesis. The market is telling us right now that one share of this business is worth $75.50. But you know us, as analysts, we don't just blindly accept the price tag. We test it. We want to know if buying at $75.50 means we're getting a massive bargain or if we're actually overpaying.
Now, what's really interesting about this slide is the massive tension in the data. On one hand, we have this incredibly bullish signal. Black Hills Corporation is a legendary dividend payer with 55 consecutive years of dividend increases. I mean, that is a hallmark of extreme stability. But, on the other hand, the data presents a frankly terrifying bearish signal. A standard discounted cash flow fair value sits at an abysmal $18.55. That represents a negative 306.92% margin of safety. So we've got a massive discrepancy to solve.
So here's our roadmap for the explainer. 1. The BKH hypothesis. 2. Absolute valuation models. 3. Relative peer valuation. 4. Asset-based valuation breakdown. And finally, 5. A final intrinsic value synthesis.
Okay, Section 1, the BKH hypothesis, examining the foundation. Let's look at the foundational numbers. BKH is a mid-cap utility company with a market capitalization of $5.76 billion. Over the trailing 12 months, they've pulled in a very solid $2.31 billion in revenue, translating to $291.7 million in net income. So they're undeniably profitable. But look closely at that debt-to-equity ratio of 1.23. This shows they rely pretty heavily on leverage to fund their operations. High leverage means a higher cost of equity, which is absolutely going to penalize riskier cash flows in our math. For a utility company managing massive physical infrastructure, carrying more debt than equity is completely common, but it's a crucial factor that's going to impact our valuation models.
Moving right along to Section 2, Absolute Valuation Models, DCF, DDM, and RI.
Now, to maintain strict analytical integrity across our absolute models, we need to explicitly declare our assumptions. Because the raw data doesn't provide a precise weighted average cost of capital, we have to establish sensible defaults to calculate present value. We're assuming a standard market risk premium of 6% and a terminal growth rate of 3%. That 3% perfectly mirrors long-term inflation and GDP growth for a mature, regulated utility like BKH.
Our first absolute test is the classic discounted cash flow, or DCF model. The logic here is simple but really powerful. Step 1, we project the free cash flows the firm will generate into the future. Step 2, we apply our discount rate to account for the time value of money and risk. And Step 3, we calculate the present value of all those future cash flows to find our true intrinsic value today.
But here's where we hit a massive roadblock. The data shows that over the trailing 12 months, BKH's free cash flow is negative $146.4 million. When a company has negative free cash flow, which by the way is often due to the seemingly bottomless money pit of capital expenditures required to maintain utility grids, a standard DCF model completely breaks down. This negative input is exactly why the provided data spits out that shockingly low $18.55 fair value price. As an analyst, you have to recognize when a model is just the wrong tool for the job.
So what do? We pivot. For a company like BKH, the dividend discount model is a far superior absolute valuation tool. Why? Because while their capital-heavy free cash flow is negative, their dividend history is incredibly reliable. We use their current dividend yield of 3.73%, their manageable payout ratio of 69.14%, and their 5-year compound annual growth rate of 4.45%. By taking that expected future dividend growth and dividing it by our required rate of return minus the growth rate, we get a much clearer picture of what the stock is actually worth to an income-focused investor.
As a kind of backup absolute test, we can also look toward earnings-based models, like the residual income model. This model neatly bypasses the issue of negative free cash flow entirely. It starts with the current book value of equity and adds the present value of future residual income, which is driven heavily by BKH's return on equity, currently sitting at a respectable 7.63%. When we rely on these earnings and dividend-based absolute models, the data provides an alternative fair value price based on EPS of $64.22. This gives us a much more realistic absolute valuation baseline than the broken free cash flow model. At $64.22, we're looking at a negative 17.57% margin of safety compared to the current price. Still not ideal, but way better than that apocalyptic negative 300% figure we saw earlier.
All right, Section 3, Relative Peer Valuation, the market's view. Here are the specific multiples the market is currently assigning to BKH. They're trading at a price-to-earnings ratio of 18.97, with a forward PE of 16.56. Their enterprise value to EBITDA sits at 12.52, and the price to sales is 2.50. Now, in the utility sector, these are relatively standard multiples. However, to really know if BKH is cheap or expensive, we have to benchmark them against comparable public utilities, like Xcel Energy or WEC Energy Group, and crucially, check BKH's own historical averages.
And this brilliantly illustrates the relative valuation story right here. BKH's current PE ratio is 18.97, but their own 3-year historical average PE is only 15.83. The data explicitly notes that the current PE is trading at nearly a 20% premium compared to its 3-year average. So, across the board, BKH is trading above its historical multiples, which signals potential overvaluation in the relative market right now.
Next up, Section 4, Asset-Based Valuation Breakdown. Let's test the physical footprint. To figure this out, we compute the net asset value, or NAV. This involves taking the fair market value of all total assets and subtracting all liabilities. For a heavy infrastructure utility company like Black Hills, this is massively important. Their physical power grids, pipelines, and power generation facilities have immense, tangible value that acts as a sort of gravity well for the stock price.
The most telling metric here from our data is the EV to assets ratio, which sits at 0.95. This is fascinating. An EV/assets ratio of slightly under 1.0 indicates that the market is pricing the entire enterprise at just about or slightly below the book value of its underlying physical assets. So while the stock might look expensive on an earnings basis, the sheer replacement cost of their utility infrastructure provides a very strong floor for the stock price. The market is basically paying for the physical assets at cost.
Finally, Section 5, Final Intrinsic Value Synthesis. Let's bring it all together.
Let's look at the actual valuation gap. Our first data point is that $18.55 price, the raw DCF model that was totally broken by heavy capital expenditures and negative free cash flow. We can largely discard that. Our middle point is $64.22, the EPS-based fair value that aligns much closer with their dividend stability and earnings power. And finally, the third point is the current market price of $75.50.
As analysts, we have to thoughtfully weigh the reliability of our models. For BKH, the DCF has incredibly low reliability due to the negative free cash flow dynamics of their specific utility operations. But the dividend discount model has highly reliable outputs because of that pristine 55-year dividend streak. Relative valuation offers medium reliability, showing us they're trading above historical averages, and the net asset value also provides a solid medium reliability floor.
Putting it all together, here is our final synthesized verdict. The heavily skewed DCF must be thrown out. The EPS fair value anchors us securely around $64.22. The fact that the current PE is roughly 20% above historical averages confirms that the market is currently paying a premium. Therefore, our judgment is that BKH's intrinsic value sits somewhere in the mid-60s. At the current price of $75.50, the stock is mildly overvalued. Which leaves us with this final provocative question. Does a legendary 55-year streak of dividend increases actually justify paying a premium over a stock's true intrinsic value? For an income investor seeking the absolute safety of a 3.73% yield, maybe overpaying for those underlying assets is a calculated risk they're willing to take. But purely by the numbers, the margin of safety just isn't there at $75.
And that wraps up our deep dive into Black Hills Corporation. Thanks so much for exploring the Valuation Lab with me today. Remember, understanding how to appropriately apply and weigh these models is the absolute key to seeing the market clearly and avoiding purely emotional investing. Keep questioning the numbers, and I'll see you in the next explainer.